Portfolio Builder members, today was the most profitable day we've had in our portfolio to date, earning around $3.50 a share. I did the math out in our model portfolio, came out to $3.33 a share, and this does not count the 41 cents that we did put into the long FXI put option. So we'll go over it all, but really quick, just to go over it, you are most likely assigned. In fact, everyone I've spoke to is assigned. If you're not, you can just buy to close your covered call. But for most of you, you need to get back into the SPY, purchase a multiple of 100 shares. For every 100 shares you have purchased, sell to open the June 24th, 2019 $293.50 call option. That's for a credit of $1.97. And so if you do the math, the SPY is worth $2.95 as of writing this. We're agreeing to sell our shares for a loss of $1.55. And so to calculate that, just $293.50 minus $295.05 is a loss of $1.55. But that's okay because we're receiving a credit of $1.97. So that's what we call the in-the-money defensive covered call. The profit on that is just a little bit more than what we're going to take and invest in this put option. And I'm expecting these put options to potentially return a 10-to-1 profit when the collapse of China begins. And I believe that quite soon we're going to see sanctions being placed on China. And if nothing else, cause some serious fear in these American-based ETF products that have been created by the banks and funneling cash out of America into these shady Chinese corporations, which in this evening update I'll spend a lot more time on. But the bottom line is buy to open the September 20th, 2019 $38.50 put. And again, I want to stress that we're just taking free money out of the option market in the secure SPY ETF. We're taking that free cash, and in today's alert, we're not trying to make a big profit. What we're trying to do is set us up to potentially cover this position this afternoon if the SPY does travel lower. So we have a $2 cushion where we're protected for the most part on the SPY ETF. If the market goes flat or higher, we get that baked into the cake profit that we always talk about. And that's that spread. That's when you compare the loss on the underlying if we're assigned compared to the option premium that we're getting paid. So this is designed to essentially give us around $1.50 of absolute protection on the downside, plus generate a profit of about 45 cents, which we're reinvesting into a longer duration put option on FXI. So that's the September 20th, 2019 $38.50 put option. And again, timing is very difficult. Trying to predict stock crashes, turbulence in the market, most of the time it just doesn't happen. So that's why we are carefully trading the SPY, pulling the income out of the option market, letting all the stock speculators gamble. We're playing it smart and safe. And anytime I've had a record-breaking profit, I tend to immediately assume people are going to start taking profits and play it safe for a period of time. So next week, there's the risk of some sanctions being placed on China. However, the word is that the government has delayed these sanctions against China because they're hoping that the trade talks will resume. Of course, I don't think they will resume, which is why we're playing this setup where we're long America and short China, but we're still playing it safe with the covered call to protect downside risk on our underlying asset. So the profit was $5,661, not including what we put into the FXI. So $3.33 a share profit is what came out on my P&L. And now we're reinvesting even more into another put option. So let me look at the track record. These are the current put options we have open. And so today we will add another one, which will go right here. That's the new September 20th $38.50 put option. So you can see how I've inputted that into my open position. So you're seeing I'm getting a nice pile up of downside protection for free, financed by these call option speculators. And then the new trade is this, which is $1.97, 17 contracts, because I have 1,700 shares of the SPY in this model portfolio. You can see this is where we were assigned, so we got to keep the spread. We entered that when the SPY was at like 292.17, I believe, and then we were assigned, so we got to keep the spread, which is totals $3.33 when you add the option premium we got to collect and the increase in price of the SPY from when we wrote the call option. And so again, this is way higher than the profit I normally like to go for, but I was pretty confident the Fed would hint at lowering rates and that the market would react with a big move up. So it played off. Every Fed speech so far this year has been a huge move up in the markets. And so that's currently the play. After writing that, our profit margin jumps a little bit higher, but remember, the track record will show a slightly inflated return until we cover that covered call. So if you think about it, this is not including the $1.50 that we have to give back on this covered call because it was in the money. So the screenshots that I provide to you each day in the email and the video is after I've covered and before I've written the new covered call. And so you can see our true return is at 9.3, and after we wrote this in the money covered call, it's now reporting 9.8. So that will drop down a little bit after we cover the position on Monday. Now, I do want to make everyone aware that if everything goes smooth today and the SPY trades flat, bobbles up and down $1 or so, we're not going to do anything. We'll wait till Monday and put on the new trade on Monday. However, if the SPY does drop by closer to $2, this will make the value of that call option we sold quickly lose value. So that means we can buy it back for a profit and then sell a new covered call at a higher yield rate. Because the volatility will be increasing, we can get a better price on option premium. So we're in a high alert political arena right now where there's going to be announcements that are going to cause some shocks to the market. And our protocol is the same. Buy to close the covered call for a profit and then sell a new covered call for a better deal. So as volatility increases, the prices of these option contracts grows by multiples. In fact, if we just go back to earlier this month, I can illustrate just how much more profitable the relative trades become as volatility goes up. So let me just show you guys this so you get a feel for just how lucrative it is to be brave in the face of fear in terms of our strategy. So if we go back to just the beginning of June, when the VIX index was at 19 on 603, compared to the VIX index at 1450 today. So right now I can sell a call option with 3 days to expiration, pretty close to the money, for around 88 cents or 62 cents. Okay, so that's good, but it's not great. And if I go into the money, the profit gets smaller and smaller, and of course I'm limiting any gains to the upside. But however, if I go look back, and I go back to June 3rd, and I pick an expiration that is similar time distance away, in fact, I'll go even less. So this will have even less days, and you can see. So this call option has 2 days instead of 3, and it's priced around $2 to buy an in-the-money covered call. And if I go out to another expiration away, you can see it jumps up to $2.50. So in one case, we can make 66 cents, like right now when volatility is low. But if the VIX index just picks up $5, that quadruples. The price of the call option quadruples. So the point is that in the moment of fear, when the SPY index is pulling back, it's going to make that call option relatively more valuable than it was when we sold it. So we're not going to be able to, in that exact moment, buy back the call option and necessarily reduce all losses on the underlying asset. But when we write the second covered call, then the premium is going to be much more lucrative. And so it's when you write that second covered call that you can end up with a profit from a series of 2 trades. So just to reiterate how this would work, so everyone's crystal clear. Here's the contract that we sold, 293.50 call option. If the SPY were to start to drop in value today, the cost to buy to close will reduce. So we'll be able to get out of that option contract for a profit. Now, most likely, the underlying asset in that point in time will have lost a little bit more than we're gaining on our covered call. And that, again, is because as the VIX goes up, the relative value of these call options increases. So what do? Let's say this has traveled all the way to 293.50. Well, the VIX will be spiking up. We're going to buy to close it for a profit. And then we're going to sell to open a new covered call and simply lower the strike a couple more dollars. And all of a sudden, the relative option premium will have been jacked up much more expensively than it was just earlier today. And that's when we generate that profit. And those periods after that. So it's really, as volatility spikes, is when we want to be there to roll over these positions, take profits on the covered calls, and continue to sell more covered calls. Now, are there chances that the SPY can just drop so precipitously that we can't react quickly enough? Sure, that is possible. In the month of May, when the S&P 500 lost 6.5%, we bobbled around from 7 to 6% total portfolio return. But the second that volatility started to die down and the market rebounded, we quickly jumped up 2.5% in our portfolio, which is much faster than we normally achieve returns. In general, we're only trying to make 1% in a month. However, in the month of June, we're up nearly 3%. So this is an abnormally highly profitable month, and that's because we've been able to take advantage of much higher volatility, much better deals on selling call options. And so again, the volatility is now getting depressed, so we're having to take worse and worse deals with these call option purchasers. But the good side of that is that we can also buy put options for much cheaper during this period of time. So we want to buy the put options when volatility is low, and we want to aggressively sell call options when volatility is high. And that's how we can really maximize the profits with this program. Now, I do want to note that this is the last day you can save $1,100 a year on our basic membership program. Call Dean or Chris, 505-322-7515. If you've been talking to Dean, give him a ring. If you've been talking to Chris, 760-803-5335. You're not going to want to miss out on our trade alerts in July. I can tell you what's going to happen. Trade tensions are going to implode. Sanctions are going to be placed on China, and volatility is going to rocket higher. And as you can see, that's extremely profitable if you're in our business of owning the SPY, selling call options to speculators, and then taking a piece of those profits and putting them into put options on China. And I believe those have the potential for a very large return if my predictions are correct. Now, if I'm wrong, market flies higher, trade deal comes on the table, we're going to make the same boring return that we're always making, around 1% a month. It's not a problem. But if the volatility does spike and tensions do rise, we can aim for a little bit higher return, closer to 2 to 3%, while still having a very conservative, safe strategy that puts protecting capital at the top of the list. Another bonus, if you do upgrade, is that you're going to get 30 days free in our Diamond Club, which trades on Tuesdays, and our Thursday trade alerts, which we call the Whale Club, which is long the TLT. So what makes a good portfolio composition right now is to basically have half your portfolio either following the Monday, Wednesday, Friday alerts, which is the SPY, and then put another half into the Whale Club. And that currently is trading TLT, the U.S. Treasury market. And so this is what has made people like Ray Dalio so rich, is by having a good mixture of those two. When one goes up, usually the other goes down, and it helps you really stabilize your profits and reduce potential drawdown. So it does make a lot of sense if you do have a large amount of savings to just split it right down the middle right now during this time of high risk in the market. So we can use the Monday, Wednesday, Friday program to crank out profits, get some downside protection against China, and generate consistent profitable returns just by selling call options to stock speculators. And in the Thursday program, it's going to act as a buffer to protect your stock portfolio, but also, if I'm right, and this does escalate, that TLT can fly from 132 to at least 144. So that portfolio has a huge exposure to the TLT, and it also has some interesting shorts on specific Chinese companies, currently Alibaba. So thanks again for your time. If the SPY travels down by about $2, expect us to buy to close today's trade alert and sell to open a new covered call another $2 or $3 below the trading price at the time that this happens. So I'll send out an emergency alert likely 1 hour before the close if that is the situation. Otherwise, take no action. If the market has fun and flies up today, great for us. We can rest assured that there's nothing to worry about and have a nice safety cushion over the weekend. So that's the update. We will have a topical update this afternoon, showing you all the news I've collected and articles and the potential for an emergency alert if we need it. So thanks again. New Trade Alert Monday. Call Dean or Chris, save some cash, support our program. We really appreciate you. Thank you.